Hey, good morning, guys. Welcome to Market Mondays. Hopefully, you guys had a great weekend, and I'm going to give you guys a quick update on everything that's happened last week, especially with the whole Fed update and how it's going to impact mortgage rates moving forward. Before I get right into it, I'm going to do a quick dad joke. Dad joke today is, what does the escalator say after it stops working? What does the escalator say after it stops working? Nothing. It just stares. Get it? Stairs? Pew pew. All right, so getting right into it. Last week, the biggest announcement last week was that the Fed announced that they were going to lower the Fed rate by 25 bips or 0.25%, going down to about 4.5. So that was the biggest news. Now, fortunately, what's tough is that whenever the media receives this news, they blow up the news and say, "Hey, oh, the Fed lowered rates, blah 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 blah," and everyone they make everyone think that mortgage rates and every other rate that's impacted by this is impacted by this, and all the rates lower by a quarter of percent, which is opposite of what's true. So if you guys, I did a post on Facebook yesterday on my personal page. You're more than welcome to share it. I'd have a chart in there. I explain the situation, but for the most part, please don't fall under the misconception that because the Fed rate falls by a quarter of percent, so will mortgage rates. Okay. That's not exactly how it works. It's not directly related that way. Mortgage rates are an asset class that you can buy, which are impacted by supply and demand, not the Fed rate at all. So supply and demand is determined what mortgage rates do. Fed rate involves interbank transfers. So just because the Fed rate lowers the Fed funds rate by a quarter of percent does not mean that the mortgage rates will fall by a quarter of percent. They are tied to each other, but through almost like a third connection. So essentially, the Fed rate impacts the economy, and the economy then impacts the mortgage rates and stock prices once they kind of respond. So for the most part, it's hard to say, and you can't say this, is that if the Fed rate goes down, mortgage rates go down. And then the vice versa also is not true. I've seen the opposite happen. So it has nothing to do with that direct relation. It all really depends on the context of the economy. So it's really hard to predict is what mortgage rates will do if the Fed rate goes down or up. There's really no way except until we find out the day of, honestly, and what mortgage rates behave. So I'm going to show you guys a chart. It explains, that relationship. So right now, if I'm looking at this chart, the risk red line is what the Fed made the announcement last Wednesday. Okay, last Wednesday they made this announcement saying that the Fed rate is going to be lower by a quarter of percent or 25 basis points. What directly happened after and during that day is that mortgage rates actually got worse. So that gives you an idea of that mortgage rates responded that day almost immediately after the Fed made that announcement. Mortgage rates got worse after that as well. Also, so just to give you guys an idea that they're influenced by the Fed rate, but it's not directly impacted by the Fed rate. That's two different things. So it's like a ripple in the water. It's impacted, but we don't really know the long-term effects of what's going to happen with mortgage rates because the Fed rate goes down. So, but what is really important right now is that one, the media doesn't know what they're talking about. That's number one thing. Two is the Fed announced what's called the dual mandate a couple years ago in regards to how they were going to handle the economy. The dual mandate is how is inflation going to behave, and how is the unemployment rate or the labor market going to behave. So for the most part, inflation has done as well as it can. We were, in the sevens to almost 9 to 10%, 2 or 3 years ago. Now we're back down to below 3%. So for the most part, inflation has moved a lot within a year. I think in 2023 and 24, it moved quite a bit lower, and it's gone as much as it can. Right now, it's just hard for it to get to the dual mandate target of what the Fed put out at 2%. They want the inflation report showing 2%. That's going to be really hard to do at these levels. The only thing that's really going to drive mortgage rates in a more faster fashion, that's going to, as I know, as a reliability as of right now, is that the unemployment rate and the jobs reports that come a few days before and a few days after the unemployment rate comes out. The unemployment rate comes out pretty much the beginning of every month, and that's what we call Jobs Week. So the unemployment rate back in July 30 to be exact, when it came out, it went up to 4.1%. Okay. Or sorry, it went down to 4.1%, which caused mortgage rates to go up, right? And then within this cycle, we had a bit of a peak, but as soon as the unemployment rate came out in August 1st, mortgage rates dropped immediately the day of, and then continued to get a little bit better even the few days before, because up to about 2 days before, within the 2 days before the unemployment rate comes out, there's some other jobs reports that come out to show that the labor market is weakening, and then the unemployment rate shows that it is higher. So a few days leading up to that, it showed improvement, and then the unemployment rate, when it came out, even put the nail in the coffin, saying that the labor market was weakening, and we saw mortgage rates drop drastically in this section. If you look at it, it's almost a point from, let's see, it's almost 6.75 in this conventional range for this number to about under 6.6. So let's say 6.57. So almost a quarter of a percent drop in those 2-3 days because of those labor market. Every report showing that the labor market was weakening. The next time it happened, we saw the same thing, where in September, the unemployment rate goes up to 4.3. So you can also see same behavior, where a few days leading up to it, we saw a lot of reports showing that the labor market was weakening. Unemployment rate came out, mortgage rates still got better. Then this is where I locked a lot of clients in my most recent lock. And then there's another 1 or 2 days after where there's a revision from the previous month. And then mortgage rates got a little bit better as well. Now, with the Fed rate going down, okay, keyword going down, mortgage rates responded that day by going up. Again, it's not to say that if the Fed rate goes down, mortgage rates go up, or vice versa, or whatever. It's really hard to figure out what the direct correlation is, because there isn't one, because it all depends on the context of the economy, of what's happening at that moment. So I'd say the Fed rate determining what mortgage rates are going to do in the future is probably right now the most unreliable indicator, because we just don't know. However, what I can say in the short term is that the unemployment rate and the labor market data is going to be the biggest reliable indicator of how mortgage rates are going to behave. If the labor market shows weakening, people are staying out of jobs longer, not enough job openings, and unemployment rate goes up, continuing claims goes up, initial claims goes up for unemployment, then we're most likely going to see mortgage rates get better because of it, because it's part of the Fed's dual mandate. One of the mandates being seeing the inflation get down to close to 2%, and the labor market weakening. And that's what we're seeing right now for August and September. We did see in June where the unemployment rate was at 4.2, and it was at 4.2 for about 2 to 3 months. And we've been above 4% for a long time, pretty much this entire year. So right now, we could potentially see the unemployment rate goes up to 4.4, 4.5. If we do see that, we could potentially see mortgage rates get better in the next 2 weeks. One thing to note is that these are all rounding figures, because there's a very strong chance, let's say the unemployment rate next month stays at 4.3, there's still a big chance that it actually still went up, because they do round up 4.25 to be 4.3. And there's a chance that the next unemployment rate is at let's say 3.2, it's still at 4.3. It may not seem as if it gone up, but there's a very strong chance that it will, from a very smaller percentage, because of a rounding. So something to consider when we're trying to analyze these unemployment rates is that it's a rounding, right? It's a rounding rule up to, to the 4.2, to the 10th of a percent. So that's the big thing in regards to what the Fed did last week, how it's going to impact mortgage rates moving forward. Honestly, again, in conclusion, I would not use the Fed rate as an indicator of how rates are going to be. We already saw rates start to improve in August and got better since, before the Fed messed with the Fed rate. Now, the next thing is that this Thursday is going to be a big update in regards to the second quarter GDP. GDP is going to be a big indicator as to how people have been buying with domestic goods coming off the shelves in the second quarter of this year. They're going to send out that information Thursday, which could have a big impact on rates, as well as the weekly jobless claims report. So the weekly jobless claims report Thursday, those two things may have a really impact on how mortgage rates swing. Currently, I'm still waiting to see how the unemployment rate looks in the beginning of next month, which is in about a week, on how the jobs report comes out. So that's going to be a big thing next week to kind of see how everything plays out. Probably 2 weeks from now, actually. But yeah, that's one thing I'm waiting on. So hopefully that makes sense to you guys. If you guys have questions, let me know. I'd be happy to help. Otherwise,